Hello everybody. First and foremost, I would like to thank Ms. Rebal and the entire team for having us here, giving us the chance to have this excellent discussion. Thanks for Miguel and Sima for the excellent presentation. It gives me a good opportunity to directly catch up to some topics you guys already tackled. My name is Steffen Hundt. As introduced, I'm working for the University of Applied Sciences in Leipzig. Recently, I joined the university in October last year. Before, I spent 15 years in the renewable energy industry in different positions and was mainly involved in power purchase agreement, origination, renewable energy installments, etc. So the topic I would like to discuss today is probably a thing everybody knows and more or less is involved in. So before I start with a presentation, a question from my side to you guys. How many people here in the room are already directly involved in their professional life with AI? Okay. And how many people right now currently are seeing ultimate benefit or an improvement in efficiency maybe, or even revenue increases or cost savings right now? The same number? Okay. That's a good one. We keep this in mind that more than 50% of people here in the room are confirming this one, and we see how a broader sample of people, a broader part of the market will see this one. Okay, so the next minutes I would like to structure as follows. The presentation is called Chances and Risks. So I start with the glasses is full, and I will turn into the perspective that is more empty. So we start with the AI potentials in general and in sustainability context especially, and then I switch over to especially energy markets because I believe this is one of the most important resources for AI. As you already mentioned, Miguel, we are electrifying everything, and we are talking about here a new kid on the block, which I'm going to call hyperscale data center. Hyperscale because of their calculation capacity on the one hand, but also of their based on their resource intensity on the other hand. And then, I will conclude with some of more or less attempts to outlook. So back to the questions. Where are we? What are the potentials? So I show here a snapshot of different studies which are actually in the market coping with the question, what's the benefit of integrating AI? We see that AI is improving our daily life in many aspects, first and foremost in quality of output, speed of work, sense of empowerment, etc. A lot of companies are already on the stage, which you see here on the right-hand side, these different steps. More than 44% have crossed the stage of proof of concept and are actually in the phase of rolling AI out in the organization to use it on a broader scale. This is what we can expect down the street in 2026. 60%, roughly speaking, are in front of the stage right before on the proof of concept stage or in this experimental stage of defining applications. Another graph I would like to show you, I find it pretty interesting. Would you trust AI to make purchases without checking every step? This is a more revenue-related perspective from a company point of view. So, and it's interesting that the maybes and the yes respondents together counting for more than 50%. So I think this is a signal in a market which is actually evolving. Another aspect is that more than a third of the respondents of this study, which was conducted by Hotwire Global, more than 900 professionals, more than a third said, okay, AI is actually more than a tool for me. It's a colleague or even a decision maker. Okay, but the majority still perceive it as a tool. And that brings me more or less back to this field of application. Miguel, you already said that we had this digital twin approach, which we see, which is AI-based, and what is a good opportunity. I just give you here a short overview about different fields of where we use AI actually, and in the next years down the road in terms of sustainability. So energy contracting, industry, process optimization. We heard yesterday excellent presentations about Scope 3 management, which is a big issue in terms of data intensity, in terms of making supply chain transparent. So in this field, we see a lot of new business cases popping up, like yesterday, the companies in the lunch break who introduced their business cases, and energy efficiency. So it's a huge span of different applications. For example, dynamic load balancing, which is super important. We see companies like Siemens Energy Manager, Metron. We see this digital twin approach. Siemens is also collaborating with NVIDIA, actually, in order to investigate how to build a digital twin factory. Before I invest the CapEx, I already know what could be an energy efficiency increase. For example, how can I optimize the logistics within the facility, etc., before I invest one single euro. We already heard predictive maintenance. We see different startups here, or even mature business cases like uptake, generative designs like Autodesk or Citroën. So it's a huge span which is actually evolving. I think it's not a big surprise for us. You guys are aware of this one. I just want to frame this as this is actually a huge potential we have in order to move forward and accelerate this way down to net zero. And the actually snapshot, which I want to emphasize, is the market is at the beginning. Like you said, or like your hand raise has shown, you already see a benefit. Here is what is actually the status quo. Does AI pay off right now? And indeed, it's just too short to ask this question, but it gives us a sniff, more or less, where we are right now and where we will go in the next year. So which effect has AI shown in the last 12 months in your firm? In Germany, compared to the rest of the world, in this PwC survey, we see it more pessimistic, actually, than the others in terms of cost reduction and revenue increase. On the other hand, this is not shown here. A lot of CEOs in Germany, which were asked this question, see that their business is more and more ready for realizing this potential. So it is a kind of state-of-the-art snapshot, not more and not less. We see a move right now from this basic tool approach that I use one LLM or a small language model or whatever, a neural network, into this agent-based approach that we stuff or create a kind of workflow agent like N8N, for example, which is above the different AI tools. This AI workflow agent has a memory and is managing and controlling the different AI applications below. So it's the next step to get more and more independent from a technology point of view. Only 30% of the respondents from a survey of the colleagues at the university in Pittsburgh has shown that less than 30% of success of this actual workflow AI agent-based approaches is actually observable. And the colleagues of Deloitte, which are also here at the conference, they conducted a good survey, which is framing this one that we see the red bars, this is a hope, and the blue bars, this is the actual achieving. So in terms of improving efficiency and productivity, and I guess most of the hand raises are related to this one, we see pretty short-term again in terms of revenue increase and cost reduction. It confirms the study of PricewaterhouseCoopers that we see more hope than actual gain. I think not surprising for an uprising market, but we see definitely out of these numbers a potential, a kind of a forward-moving atmosphere in the market, and this becomes even tremendous when we see the CapEx number a few slides further. So that's the good news. This is the potential gain. This is the actual atmosphere in the market. Everybody is testing around. The other side of the same game is the question: how resource intensive will this journey be? And this diagram should show us, or should give us an idea how the new kid on the block could look like. What you see here on this diagram, two graphs, the red line and the blue line on the bottom. In between, you see this light blue area. This is the forecast of the International Energy Agency, which came out mid last year. It's a forward-looking, ultra long-term forecast. I show this one until 2030. The forecast in the report goes much longer. They are dividing in different energy consumption scenarios. The y-axis is in terawatt hours, so it's a game changer, definitely, terawatt hours. And we see that it depends on how aggressive AI will be infrastructure-wise installed and what is the corresponding electricity consumption. So if we install in a light speed hyperscale data center with the corresponding infrastructure behind, we will probably more move to the international energy scenario liftoff, which is the most aggressive one. If it's controlled, regulated, if we have a certain dose of this growth rate, we are moving more to the headwind scenario. But in any case, it is a huge increase in terms of electricity consumption. I found it interesting, Miguel, what you said in terms of on-site production. I come to this point later on, because here, with those loads, with those electricity consumption profiles, it is really difficult to put all the necessary production capacity on your site next to the data center. So that will be a game changer from a digitalized organization to an agentic AI agent-based organization. What you see in the bubbles is just a kind of idea related to the International Energy Agency report, how we perceive AI as an assistant initially, and then maybe it becomes a junior employee with a higher degree of freedom and not deciding by itself, but it's more and more preparing the decision, and then it fades a little bit. We are dividing the AI evolution in 5 phases. Recently, from a scientific point of view, I just show you the first 3 phases. In phase 4, we have a complete autonomous environment ecosystem, which is deciding by itself. So it's another question if we how we find the scenario and how good it will be anyway. Down the road, what is more interesting, based or having in mind that the electricity consumption will definitely explode, is another thing, how we use AI. That will also determine how flat or how sharp the increase will be of the consumption curve. According to Google reports, we Google daily worldwide 16.4 billion Google requests per day. Everybody knows the structure of those LLMs. It's like when you go to the cash point at McDonald's, the employee will not ask you, what do you want to have? They will ask you, do you want to have mayonnaise? Do you want to have ketchup? Do you want to have this and that? Because they bring you in a position to answer with a yes and no. And humans are used to answer in tendency with a yes. And that's the same like the prompts are designed, right? You're prompting something and the response is immediately received, and the system will ask you, should I do this and that? And you can just answer yes, and then you get the next step. So that's the reason why we see a huge explosion compared to one Google request, which is around 0.3 watt hours, compared to a ChatGPT 5 prompt, which is between, this is here more kind of average forward-looking assumption. It is something between 15 watt hours to 25 or even above. It depends what you're prompting. If this is a nano banana picture or video generating request, we are far beyond 25 watt hours. So that is a tremendous increase how we use this technology. This, in quotes, laziness with this yes and no answers, and you are prompting more and more. That will determine how many megawatt hours you are at the end of the day producing at the data center, and every prompt has a certain footprint. It depends on the style of prompt, what you want to have, and how many prompts, how good the prompt engineering is, and how many prompts you need to get to your final results. So this is the very micro perspective, which really shows what we have in front of us. And yeah, this is, I think, the more than obvious conclusion out of this game. Especially the right-hand diagram, from my perspective, is super serious, because in the wake of this electricity consumption, we see the perspective of the International Energy Agency, where the emission will go based on hyperscale data center, based on AI infrastructure. We see an exponential increase in GHG emissions. And why is this exponential increase? The simple answer is due to the energy demand of this technology. We see a huge increase in demand, while the grids and the electricity production is not as far as it should be. We are lacking behind storage solutions in the renewable energy business, and we have not the capacity to provide 100% green solution for those huge electricity loads. And that's the reason why we have a balancing market, which is then which needs to coexist as long as we have no 100% storage solution or stored battery storage or other technologies backed balancing markets. As long as this is the case, we see this curve definitely uprising. And on the left-hand side, yeah, you see a snapshot from this report. What's the reason behind? So the two areas next to the axis, coal and natural gas, which are the main drivers of why this curve is upward sloping. And by the way, when you remember a few slides before, this light blue area between the very aggressive case and the headwind case, the lower case, the International Energy Agency draws a line in between, which is a base case. This curve here is related to the base case, okay? It's not the emission for the most aggressive case, so it can be even higher. You can check out this one by yourself in the report, which is tremendous. So we see the user side. Like all of us, obviously see a potential in this technology and see already short-term ultimate effects, and down the road even more pronounced effects. This is the one side. We see the energy intensity of the other side. The question is how carved in stone is this perspective, and the answer is here on the slide. What you see with the bars is the investment volume commitment of the Magnificent Six, Tesla, Apple, Meta, Microsoft, Alphabet, and Amazon, the biggest investors in hyperscale data centers. So in 2025, this investment commitment, which they made, is related to investments 2026 downwards, okay? So you need to read this diagram in relation to the cake diagram, meaning that the commitments in 2024, 2023, they were more related to this cake diagram with 1.7 trillion US dollar. Most of them were in the modeling architecture of AI, in coding, okay? And now it shifts, the capex shifts to the infrastructure, which we need in order to operate this technology. And this is seen in the cake diagrams for 2026 downwards. Amounts are increasing exponentially, the same like the emissions. And this is, from my perspective, the carved in stone scenario, because this is not non-binding, okay? This is not a letter of interest. These are signed investment contracts. And the dotted line in the bar diagram shows you, in order to give us a relativation, the government cross-investments of the US administration. So the Mag 6 companies exceeded the budget of the federal level in the US for intellectual property products, research and development. So that means we are talking about here about a never seen investment volume. Okay, so hyperscale data center, hyperscale capex, hyperscale emissions. That is the status quo. And these tech companies, from a balancing point of view, for a balance sheet accounting point of view, they have a huge amount of liquidity available. So normally these smaller, mid-sized co-located data centers, which we know, for example, here in Frankfurt, this is one of the core markets for data centers in the European Union. These data centers were normally paid full equity. Okay, they have so many money that they don't need debt capital. But even the Max 6 are unable to cover these capex amounts by themselves. So that means we need to switch into the debt capital market in order to realize, or in order, from their perspective, in order to realize these investments. On the other hand, to mimic this one with the survey results, when the people were asked, okay, do you see a benefit right now ultimately? The same can be as a proxy seen here when you relate the revenues of those companies to the capex. Okay, the number is shrinking. And that is actually the question in the stock market. Investors are more and more cautious and less confident because companies like OpenAI actually struggling to realize their conversion rate. Okay, the people are using this technology, but nobody, I'm a little bit hyperboling, but in tendency, not enough people are willing to pay 20 to 50 bucks per month for using this technology. So they have a problem in converting and realizing business cases. That's another thing with mature companies like Amazon or Meta, which have already a stable cash flow basis, which can incubate a little bit this this investment amount. But even for those companies, if we relate revenue to these huge capex explosions, the market is asking itself, okay, where we are reaching the tipping point, when is this number growing? And to relate this energy-related problem that we have this huge electricity demand to the capital markets, we need to understand how the cash flow waterfall looks like for data center in general and for hyperscaler in particular. We have the revenues, the cash inflows, minus the energy costs. You can take as a rule of thumb 40 to 60% of the entire operating costs are energy related, electricity related first and foremost. You have then the debt financing costs due to the inability to cover those amounts full equity. And the dividends from a shareholder perspective, which are actually in the studies which I have read, less than 2%. And this is market structure I would like to end up, and where I would like to draw the switch to contents you have placed, and you, Miguel, you already talked about offsite solution first and foremost, power purchase agreements, which will play a crucial role here in this game. So the data center is structured as a special purpose vehicle, like some of you or most of you probably know from structured finance markets, from the renewable energy market. Every wind park, every solar farm, every airplane is an SPV normally. So we have the sponsors like Equinix, for example, or Iron Mountain, who are building this one as a co-located data center. And we have the tenants, which are closing a lease agreement with the data center. And this tenant, for example, is OpenAI. Okay, they are actually building their first hyperscaler in Albany, in the south of America, which is planned in 5 phases. It's called Stargate, like the movie Stargate. I don't know if we have here the science fiction fans here in the audience. The first phase is called Project Louis-Cruz, and this project will come online in the second half of 2026. Loads right before 1 terawatt hour per year, so super high. This first phase is structured to be in the 5th phase down the road, 2050. Then we, according to OpenAI, the final stage should be realized. This first stage should then evolve as the facility manager. Okay, so the plan is in the next decades that AI is the facility manager of the hyperscaler, less humans in the loop. So anyway, you have the tenant who is then training its model on the data center infrastructure, and after having trained it, then you are in the so-called inference period, where you operate the trained mechanism. And as I said, due to the lack, or due to these huge capex, and due to the inability to cover this one full equity, you see actually the tendency in the capital market that those sponsors are demanding more and more a bridge loan, a bank loan from a syndicate of banks. To our research at HTWK, we are talking about, roughly speaking, 3 dozens of banks worldwide covering 60 to 70% leverage of this capex, of these 300 billions investment volume. So that is a huge concentration risk. No bank is able and willing to have those things on the asset side of the balance sheet. So they need to bring these loans in terms of refinancing in a broader market. This is something which I'm going to show you in the next slide. One comment here in addition, what we also see when we look at Meta, for example, which is also a big player here in this market, the tenant becomes also the sponsor, okay? In terms of OpenAI, OpenAI is a tenant, and we have third-party sponsors. But if you look at Amazon, Meta, they are integrating also the sponsorship. They are owner and user simultaneously. This is probably for the larger firms the new normal. And as I said, the banks now financing this one with bridge loans need to refinance or need to find a way to refinance this one. And this is normally done with a market which we know latest since 2008, since the subprime crisis. Probably all of you has known these synthetic products like asset-backed securities or mortgage-backed securities. And this is actually something which we can observe in the market. Banks are building trusts from them for themselves in SPV. The SPV is then buying the loan from the bank syndicate and then dividing it into corporate bonds, into securities which are backed by the receivable under the bridge loan contract. And those receivables are then sold in smaller scales to a secondary market. And this can be done for the receivable the data center has toward the tenant, meaning the lease, or it could be the mortgage which the data center has. Then it's a more real estate related case. Then we are in the CMBS case, and we see crazy products actually, like it's not the receivable or the mortgage which is securitized, it is the chip in the data center, the GPU. Okay, this is the gold nugget in the market, actually, the GPU. Everybody wants to have the chip. We have a kind of monopoly or maybe an oligopolistic market structure with NVIDIA and some other firms providing those chips. And the GPUs are a super risky case because if they are launching the next generation, the previous one is worth very small amount of its initial nominal value. But yeah, so they are creating products according to the different scale of risk aversion for the high yield investors as well as the senior investors. If we assume that the tenant is more or less secure, because if we follow the hypothesis AI is there and it will never disappear, and we will use this technology so the lease payments will be stable, there's still a risk which I want to emphasize, and this is, remember, I go back, remember this cash flow waterfall, this is the energy cost related issue. And that pops up on the left-hand side. And now, Miguel, I would like to catch up to what you have said. It would be great to have everything on site, to have microgrids which are autonomously providing the electricity to the data center, but this is actually not the truth. To give you a number, rule of thumb, 10% on-site production actually, 90% off-site, meaning electricity comes from the grid. Okay, the forward-looking perspective down the road to 2030 is that we have an increase on-site energy of 30% to 70% off-site, but it will still have a majority stake down the road in the next years. So we see, for example, Colossus One, Grok, the AI, Elon Musk have, according to public information, have installed gas turbines without permissions, with a huge amount of emission there on the site. We see small modular reactors, especially Alphabet is testing this technology, and renewable will definitely play a role. But as I said, that's the smallest chunk, so I would like to concentrate on the offsite energy. Merchant, meaning the data center would consume on the power market for variable prices. This is a problem if debt capital providers if bank kicks in, because the debt capital provider want to have a predictive cash flow. A stable cash flow merchant is not bankable, not at all. We had in Spain 2 renewable energy assets, 2019, 2 solar parks, which were financed full merchant. So they are feeding in to variable prices. These things, a year later, were completely in insolvency because due to Corona in 2020, the electricity prices were down close to 5 euros per megawatt hour, and the revenue was not enough to cover the financing costs. So they were forced to immediately restructure. These banks had a little bit fat lip on the conferences, but were faced with reality down the road 12 months later. So this is not bankable, okay? The data center need to have a fixed price electricity supply contract. And the biggest market here is the power purchase agreement market in order to realize the sustainability goals, in order to get access to guarantees of origin, and to have this track what we call additionality. So by closing the power purchase agreement itself, a new asset will be installed based on the power purchase agreement. That will be the market. And here comes the point. These data centers have a 24/7 base load consumption profile, okay? It depends. There is a shift up and downwards depending if the AI is actually in a training session or if it's in an inference period. But as we all know, the production profile of renewable energy technology is not 24/7, unfortunately, especially without battery storage. We have this spike in August with solar power, and we have hopefully again, the last year were a catastrophe, with onshore wind in January, February, November, December. Those are the typical months where onshore wind farm gain cash flows, okay, is producing. So that's the big issue. And the only thing you can do, without battery storage, if you want to have access to renewable energy, you can calculation-wise contract with a wind park which has a bigger capacity than your consumption profile, meaning what we call in a PPA market, a bigger hedge ratio. So the smaller the hedge ratio is the relation between consumption and production. If you install more production than consumption, the hedge ratio is shrinking, and that means the PPA, an as-produced PPA is performing. But as I said, they are not looking for an as-produced PPA, they are looking for a baseload PPA, and that brings a lot of struggle to the producer side, okay? Because if you have underproduction and you are the data center, I am the producer, and I am obliged to provide you 100 megawatt hours, and I'm producing only 40, I need to cover this one to merchant prices on the market and need to buy the residual electricity. And this is, at the end of this presentation, something I would like to show you. I come back to the slide in a second. What you see here is a case which is probably not very famous. It's a wind farm in the north of Sweden. The biggest one we had for several years, Markbygden 1. I don't know if you guys heard of this one. More than 130 wind turbines were installed. That was by far the biggest renewable energy project we had under power purchase agreement transaction. The off-taker was Norsk Hydro, aluminium producer. So that's a crazy story. I don't have time to cover all these aspects. What I want to emphasize is the commercial operation date, COD, which you hopefully see in May 2019. If you have such a big farm, the wind farm goes online step by step, cluster by cluster, okay? So the first cluster went online in May 2019. The PPA was closed at that point, but it was not in the execution. In the execution, the PPA will be once the last turbine is online, okay? So from getting the first cluster online to the last turbine reaches COD, the wind farm is feeding in to merchant prices. And banks normally hope that the electricity prices during that times are high, that the SPV, the wind farm, can create a kind of cash reserve account, okay? So that was simply bad luck that during this time, Corona broke out because the electricity prices went down and the revenues were super, super low, okay? The SPV was unable to produce reserve accounts. or to feed in reserve accounts. Then the last turbine came online December 2020. This red line here is an assumed price. I just took average PPA prices I found in the internet during that time because PPA markets are super lean. You can expect that it's something between 25 to 30 euros per megawatt hour back in the days, a base load contract. And then, we see the electricity prices are increasing. In Q1 2022, Ukraine invasion, electricity prices were exploding. Okay, so in parallel, 2022, horrible wind year, horrible, really. The wind is changing. And this is something which I mean seriously, the wind is changing because the wind direction is changing. That has something to do with the Gulf Stream and the jet stream, etc. So if you install those wind turbines, then you have the so-called wake effect, okay? The wind comes from a different direction, then hitting a turbine which is standing directly in front of another turbine, and you have turbulences behind this windmill, which hits then the other turbine, and this is then not producing as expected, okay? The entire wind farm is underproducing. This is the situation in 2022, and the electricity prices were exploding. You have a base load contract in terawatt-hour dimensions, so hyperscale dimensions, and the SPV, which was back in the day owned by China, was immediately in stress because they were unable to cover the residual amount which they not produced on a secondary market for prices around $500 per megawatt hour. That was a super fast death, okay? And the SPV has no reserve. And the sponsors, under a limited recurse transaction, say, hey, look in our SPA, we are not obliged to cover this residual amount. If the SPV is in insolvency, it is how it is, okay? So where are we right now? The banks took over. There's a consortium of 5 to 6 banks, a lot of German banks, also covered by an export credit agency with our tax money. This wind farm right now lost the off-taker because Norsk Hydro said, hey, if you don't deliver the electricity like expected, then we cancel the contract. That's it. So this project is actually in a full merchant scenario, which is normally not bankable in a PPA market, but this project is right now full merchant. So at the end, I just wanted to stress a little bit the case where we could be if those baseload PPAs are collapsing and we have a connected cash flow to a secondary capital market. That could be a systematic risk if it's not handled well. So these spillover effects needs to be considered because, as Sima said, financing costs, that will have a direct effect on debt capital costs, right? And it is the same like in 2000, or could be, sorry, not is, could be the same like in 2008 or 2009. So long story short, the new kid on the block is a pretty big kid with a lot of hunger for electricity. And actually, from my point of view, this resource intensity is eroding, is cannibalizing the sustainability effects in energy markets.